ON94 Project, the Financial Freedom Blueprint. Part 4, Investing, Compound Interest, and Building Wealth That Works While You Sleep. Introduction. Welcome back to ON94 Project. So far, we've discussed mindset, we've discussed budgeting, we've discussed debt elimination, we've discussed increasing income. Now we arrive at the topic that separates financial stability from financial freedom. Investing. For many people, investing feels intimidating. The terminology sounds complicated. The financial news sounds confusing. The stock market appears unpredictable. As a result, millions of people delay investing for years. Some delay for decades. And unfortunately, every year spent waiting carries a hidden cost. Because the greatest advantage an investor can possess isn't intelligence. It isn't luck. It isn't a secret strategy. It's time. Time is the most powerful force in investing. Today, we're going to discuss how investing works, why compound interest has been called one of the most powerful forces in finance, and how ordinary people can use investing to gradually build extraordinary wealth. This isn't about gambling. This isn't about speculation. This isn't about getting rich quickly. This is about creating a system that allows your money to begin working for you. Because true financial freedom happens when your money starts producing more money. Let's begin. Chapter: The problem with saving alone. Saving money is important. Without savings, emergencies become disasters. Without savings, opportunities become impossible. Without savings, financial stress increases. But there is a limitation to saving. Savings preserve money. Investing grows money. Imagine placing $10,000 under a mattress. 10 years later, you'll still have $10,000. But something has changed. Inflation. The purchasing power of that money has declined. What $10,000 could buy today may be very different from what it can buy 10 years from now. This is why investing matters. Investing allows your money to grow faster than inflation over long periods. Without investing, you're constantly running against the current. With investing, you allow your money to participate in economic growth. The goal isn't simply to keep money. The goal is to grow money. Chapter 2. What is investing? At its core, investing is remarkably simple. Investing means using money to purchase assets that have the potential to increase in value or generate income over time. That's it. People often imagine investing as a complicated activity reserved for financial experts. In reality, investing is simply ownership. When you purchase a stock, you're purchasing a small ownership stake in a company. When you purchase real estate, you're purchasing property that may increase in value and generate rental income. When you purchase certain investments, you're acquiring assets designed to grow over time. The concept is simple. The challenge is emotional, because investing requires patience, and patience is difficult in a world obsessed with immediate results. Chapter 3. The Magic of Compound Interest. Albert Einstein is often credited with calling compound interest one of the most powerful forces in the world. Whether or not he actually said it, the principle remains true. Let's understand why. Suppose you invest money. That investment earns a return. The following year, you earn returns not only on your original investment, but also on the previous returns. Then the process repeats, again, and again, and again. Over time, growth begins to accelerate. The results often appear unimpressive in the beginning. Then something remarkable happens. The curve starts bending upward. The growth becomes exponential. This is the power of compounding. GNU Math Block Widget Always Prefetch Score V2. Content, 8 left 1 frac n. Many people underestimate this concept because they focus on short periods. Compounding rewards long periods. The longer money remains invested, the more powerful the effect becomes. Chapter 4. The Cost of Waiting. Imagine two investors. Investor A starts investing at age 25. Investor B starts investing at age 35. Everything else remains equal. Same strategy, same returns, same discipline. Who wins? Almost always the person who started earlier. Not because they invested more skillfully, because they gave compound growth more time to work. Time often matters more than amount. This is one of the most important lessons in personal finance. Many people spend years trying to find the perfect investment. Meanwhile, they lose something far more valuable: time. The perfect investment is less important than consistent investing over long periods. Chapter 5. The Stock Market Explained. The stock market often appears mysterious. In reality, it's simply a marketplace, a place where ownership shares of companies are bought and sold. Think about some of the largest companies in the world. People use their products every day. When these companies grow, generate profits, and expand, shareholders can benefit. That's the basic idea. The stock market is not a casino, although many people treat it like one. The difference lies in behavior. Gamblers seek excitement. Investors seek ownership. Gamblers focus on quick gains. Investors focus on long-term growth. Understanding this distinction changes everything. Chapter 6. Why people fail as investors. Most investing mistakes are not intellectual. They're emotional. People become excited when prices rise. They become fearful when prices fall. Unfortunately, this often leads to buying high and selling low. Exactly the opposite of what successful investing requires. Market declines are normal. Corrections are normal. Volatility is normal. Fear is normal. The challenge is remaining disciplined despite these realities. Investing success often depends less on predicting markets and more on controlling emotions. Patience becomes a competitive advantage. Chapter 7. Index Funds and Simplicity. One of the greatest investing innovations in history is the index fund. An index fund allows investors to own small pieces of many companies through a single investment. Instead of trying to guess which company will perform best, investors participate in the growth of an entire market. This approach offers several advantages: diversification, simplicity, lower costs, reduced risk compared to concentrating everything in a single company. Many successful investors have built substantial wealth using simple, diversified investment strategies. The lesson: complexity is not required for success. Consistency often matters more. Chapter 8, Market Crashes. Every investor eventually experiences a market decline. It's not a question of if, it's a question of when. And when it happens, emotions become powerful. News headlines become dramatic. Fear spreads quickly. Predictions become extreme. Yet history demonstrates something remarkable. Markets have experienced wars, recessions, financial crises, political turmoil, pandemics, economic shocks, and despite these challenges, markets have historically recovered over long periods. The investor who panics often locks in losses. The investor who remains disciplined often benefits from recovery. This doesn't make declines pleasant, but it makes them manageable. Understanding history helps investors maintain perspective. Chapter 9, Dollar Cost Averaging. One strategy many investors use is dollar cost averaging. The concept is simple. Invest a fixed amount consistently, regardless of market conditions. When prices are high, you buy. When prices are low, you buy. When headlines are optimistic, you buy. When headlines are pessimistic, you buy. This approach removes much of the emotion from investing. Instead of trying to predict the future, you focus on consistency. Consistency often wins. Chapter 10, The Difference Between Trading and Investing. Many people confuse trading with investing. Trading focuses on short-term price movements. Investing focuses on long-term ownership. Trading requires constant attention. Investing requires patience. Trading can feel exciting. Investing often feels boring. Ironically, boring frequently produces better long-term results. The goal isn't entertainment. The goal is financial freedom. And financial freedom is often built through disciplined repetition rather than dramatic predictions. Chapter 11, Building an Investor's Mindset. Successful investors think differently. They understand that volatility is normal. They understand that setbacks are temporary. They understand that wealth building takes time. Most importantly, they understand that investing is a long journey, not a sprint. The investor who remains consistent for 20 years often outperforms the investor searching for shortcuts. Patience becomes a superpower. Chapter 12, Thinking in Decades. One of the most powerful mental shifts you can make is thinking in decades. Most people think about next week, next month, next year. Investors think about 10 years, 20 years, 30 years. Because wealth is rarely built overnight. It's built gradually, quietly, consistently, year after year. When viewed this way, investing becomes less stressful. Daily fluctuations matter less. Monthly fluctuations matter less. The long-term trend becomes the focus. Chapter 13, The Moment Your Money Starts Working for You. There comes a point in many investors' journeys when something changes. The growth generated by investments begins to exceed the amount being contributed. This is a powerful milestone. It means your money is beginning to work harder. Your assets are generating momentum. Progress accelerates. This is why investing can eventually become transformational. Not because it creates instant wealth, because it creates self-reinforcing growth. Chapter 14, Financial Freedom Through Assets. Ultimately, financial freedom comes from assets. Assets generate income. Assets appreciate. Assets create opportunities. Assets reduce dependence on active labor. Every dollar invested is another step toward ownership, another step toward freedom, another step toward creating a future where your financial life becomes less dependent on the hours you personally work. That's the destination, not endless consumption, not status, freedom, choice, control, conclusion. Today, we explored one of the most important concepts in the entire journey toward financial freedom, investing. You learned why saving alone is not enough, the importance of ownership, how compound growth transforms small amounts into significant wealth, why time is an investor's greatest advantage, the difference between trading and investing, how discipline often matters more than intelligence, why consistency beats prediction, how assets create long-term freedom. The greatest wealth-building strategy is often the simplest. Earn, save, invest, repeat, for years, for decades. Allow time and discipline to do the heavy lifting. In Part 5, we'll explore advanced wealth-building concepts, including passive income, real estate, business ownership, dividends, digital products, and creating multiple streams of income that continue generating value long after the initial work has been completed. This is ON94 Project, and every dollar invested today is a worker you hire to help build your future. End of Part 4.